everybody, Dana Sparks, broker of Maximum One Greater Atlanta Realtors. And this week's contract tip is a continuation of going through the Financing Contingency Exhibit. And the biggest question is a buyer's earnest money safe if they terminate based on the financing contingency? And the answer is, well, it depends. Maybe, maybe not. There is a lot of issues and particulars and specifics that a buyer needs to pay attention to if they do want to terminate under the financing contingency exhibit and protect themselves with respect to the contract. So the last video I did was about the loan denial letter and very specific things that the loan denial letter must not be based on in order to protect the buyer. So in this video, I want to talk about where does that loan denial letter come from and when does it have to get to the seller when a buyer is terminating under the financing contingency exhibit. So again, when a buyer and a seller are contracting for a property and they're negotiating through the terms, if the buyer is getting a loan, typically they're going to make their purchase contingent upon them getting financed. The financing, and they're going to have a financing contingency exhibit in the contract that gets negotiated. So basically what this means is the whole deal is contingent upon this as one of many contingencies. So within this contingency, the buyer and the seller negotiate a time frame, and that is a certain number of days timed from the binding agreement date. And that means the buyer has that many days before they're going to terminate and be protected based on this contingency. They have that many days, in essence, to convince a lender, so to speak, that they are worthy of the risk of lending the money to so that they can get the loan and pay the seller for this house at closing. So those number of days are negotiated, and I'm going to talk about both the GAR contract form and the RE contract forms. So in the GAR contract packages, the financing contingency would be addressed on an exhibit, and the exhibit used would depend upon if the buyer is getting a conventional loan, an FHA insured loan, VA insured loan. But the specifics are the general information I'm going to cover is the same in all of those contingencies, but the form, the actual form you're going to use is different depending upon the type of loan the buyer's getting. So basically on in the GAR form, under paragraph 5 where it says financing contingency, this is the time frame, this is the number of days, and basically what it says is buyer shall have number of days, blank days, and the buyer and the seller negotiate that from the binding agreement date to determine if the buyer has the ability to obtain the loan described above. And again, we talked about this in the last video, that any denial or any buyer trying to terminate a contract based on this contingency, the denial letter must specify the loan as agreed upon between the buyer and the seller outlined in the purchase and sale agreement. They can apply for any loan they want, but the loan denial letter, again, for protection for the buyer, must be the loan as described in the contract. And so basically, I'm gonna skip ahead. The GAR contract's a little bit, I have to cover a couple of paragraphs simultaneously. So that was paragraph 5, and there's more to paragraph 5. But then in paragraph 6, it says, well, let me go back. Paragraph 5. So the buyer has so many days to determine, from the binding agreement date, to determine if the buyer has the ability to obtain the loan as described above. And above is where you put in the percentage of the purchase price, number of years, interest rate, so forth and so on. The buyer shall be deemed to have the ability to obtain the loan unless prior to the end of the financing contingency period, again, those are those number of days you negotiate, the buyer, A, notifies the seller that the buyer is terminating based on that they've been turned down for a loan, and B, provides the seller with a notice of letter of loan denial from the mortgage lender based upon the mortgage lender's customary and standard underwriting criteria. The loan denial letter and mortgage lender issuing the loan denial letter must meet all the requirements set forth elsewhere in this exhibit, and again, we're going to cover those in a minute. Notwithstanding any provision to the contrary contained herein, the loan denial letter may be provided. Okay, I'll talk about that in a second. So a buyer must terminate prior to that time frame and provide the loan denial letter. There's one sentence I skipped in there. In the GAR contract, the buyer must provide the seller this proof or this loan denial letter within 7 days from the time they send their notice of termination. And so they have to terminate prior to that negotiated time frame, and then they have to prove it with the loan denial letter. In the GAR contract, the loan denial letter can come 7 days after that notice. And it is okay if the 7 days falls outside of the time frame that was negotiated for the termination. So that's the time frame for a buyer binding under a GAR Financing Contingency Exhibit. Now, it does say that it has to be from a lender, but then the next paragraph, paragraph 6, talks about use of approved mortgage lender and the loan denial letter. Then it says if the buyer has agreed to apply for a loan with an approved mortgage lender, the loan denial letter must be from that approved mortgage lender. If the buyer is not required to apply for a loan with an approved mortgage lender, then the loan denial letter may be from any institutional mortgage lender licensed to do business in Georgia. And it must be from an institutional mortgage lender, not a non-institutional one. So in the GAR contract, further up in paragraph 2, it does have information that the buyer and the seller negotiate through regarding use of particular mortgage lender. Unless approved mortgage lender is identified below, buyer may apply for the approval of a loan with any institutional mortgage lender licensed to do business in Georgia. If an approved mortgage lender is identified below, the buyer shall apply for approval of the loan at least with such one who's identified below. Nothing herein shall require the buyer to obtain their financing through that lender, but this is just for application purposes. So in the GAR contract, in the GAR exhibits, financing contingency exhibits, it's paragraph 2, and that's where it talks about that. Then it has a fill in the blank for who you fill in for the approved mortgage lender that the buyer's obligated to at least apply for the loan for. This is really important if a buyer's terminating under this contingency, because as I just read in paragraph 6, the loan denial letter must come from one of those approved mortgage lenders that the buyer and the seller agreed upon on the previous paragraph. So what do? Well, if you are a buyer's agent, it perhaps would be in your best interest. Obviously, you want your buyer already pre-approved with a mortgage lender before you ever show them houses. But for purposes of the contract, if you are representing a buyer, it might be in the buyer's best interest to not identify a specific mortgage lender on this exhibit. That way, if it turns out that they're going to terminate under the financing contingency, their loan denial letter can come from any mortgage lender licensed to do business in Georgia. If you're a seller, however, then if you do get an offer with a financing contingency and they have not identified an approved mortgage lender, it might be in your best interest to make a counter offer back identifying a mortgage lender that you work with on a regular basis, so that if a buyer tries to terminate under the financing contingency, if nobody else is identified, that loan denial letter will have to come from a lender with whom you are familiar to make sure that it truly is a loan denial and not just trying to terminate the contract. So a little bit interesting, and again, last video we talked about what has to be in that loan denial letter, and then further on it goes on, and this is a whole nother topic where it talks about the financing contingency exhibit really is instructions for how a buyer is protected with respect to the contract to protect their earnest money or protect themselves from not being sued should they terminate based on this contingency. A buyer can come to the closing table with any form of money to the seller. It doesn't matter what loan they get. It doesn't matter if they pay cash. They can, at closing, it's all cash to the seller. If a buyer is getting financed, let's say they're getting a 30-year mortgage loan, the seller doesn't have to wait 30 years for the money. The seller gets their money at the closing table. So this financing contingency exhibit, and it clearly states it, it says buyer may apply for a different loan. So it doesn't matter what loan a buyer actually applies for. All the information in the exhibit has to do with protection for the buyer should they terminate based on that contingency. Now, in the RE forms contract, all of this information is very similar, and the time frame, the number of days that the buyer has before they're going to terminate based on this contingency, the financing contingency time frame in and of itself, that is negotiated on the purchase and sale agreement. In the RE Forms contract, the buyer's right to terminate, the financing contingency, and the appraisal contingency are all built into the purchase and sale. But the description and all the information is contained in the standard terms. So in the RE Forms, the standard terms, paragraph 6.3, is where it talks about the financing contingency. And the same thing, if a buyer is going to terminate, they must do so within that time frame negotiated, and they must prove it with a loan denial letter. Now, if a buyer and a seller are binding on the RE Forms contract package, that loan denial letter must come simultaneously with that termination. And it says, this contingency shall be granted by the seller only if the appropriate related box is checked thereto in the actual contract and thereby selected by the parties. If this contingency is not selected, it's not part of the contract. That's true of any provision in the contract. All right, subject to any expiration date expressed in writing in the contract, the financing contingency is defined as the seller's grant to buyer for the right to terminate the contract in the event the buyer is unable to procure financing under the terms expressed in the contract. Again, the loan denial letter must be for the loan that's described in that letter must be the loan that is filled out on the purchase and sale agreement and negotiated between the buyer and the seller for those terms. The following conditions shall also apply. If the buyer chooses to terminate the contract based on the inability to obtain financing as described hereunder, the buyer must give the seller written notice of termination of the contract along with a written statement from the buyer's lender indicating the reason for the lender's denial of the loan approval. And again, we went through those specific reasons in the last video that it can't be based on. So again, if a buyer is going to terminate under the financing contingency, in order to be protect their interest with the contract and protect their earnest money, number one, they must terminate within the time frame. Number two, they must provide proof, meaning a loan denial letter. The time frame within which that comes, if you're binding on the RE Forms, must come simultaneously. If you're binding on the GAR contract, you have 7 days to provide that loan denial letter. Whom can the loan denial letter be from? In the RE Forms, it doesn't specify that, just a mortgage lender licensed to do business in Georgia. In the GAR contract, it's very specific based on what the buyer and the seller did negotiate for or did not negotiate for to identify an approved mortgage lender. And then the loan denial letter must reference the loan as described in the purchase and sale agreement in the contract or the exhibit, and must not be based on those items we've already discussed. So again, there's a lot to it. Make sure that the buyers and the sellers understand what it is that they are agreeing to and what their level of performance is and what the consequences for lack of performance is in order to protect themselves with respect to a purchase and sale agreement and having it contingent upon a buyer getting financing. Thank you so much for watching. Dana Sparks, broker of Maximum One Greater Atlanta Realtors, satisfying your needs with service, innovation, and education.